You're working hard, saving your money, and investing for the future. But what if I told you that a single, giant threat could make all that hard work vanish in an instant? The world's governments owe a combined total of 338 trillion US dollars. So, are we speeding towards a financial catastrophe like we've never seen before? Or is this whole thing just a scare tactic, a bunch of numbers exaggerated by politicians and the press? You hear one group saying the sky is falling, and another group saying it's all perfectly manageable. That's why we're here. Welcome to the debate. We're going to break down the myths, question the official stories, and help you figure out what's really going on. Let's get right into it.
Ladies and gentlemen, welcome to today's critical debate. The evidence is overwhelming. Developed countries are careening toward an unprecedented debt crisis that threatens global financial stability. Let me start with the cold, hard facts. Among advanced economies, debt levels have reached historic highs that would have been unthinkable just decades ago. Japan leads with a staggering 235% debt to GDP ratio, while the United States sits at 123%. The Eurozone averages 88% debt to GDP, with France at 113%, Italy at 138%, and even Germany, traditionally Europe's fiscal powerhouse, carrying 63% debt to GDP. But here's what makes this crisis imminent. It's not just the levels, it's the toxic combination of factors converging right now. First, rising interest rates are creating a perfect storm, with the era of near-zero interest rates firmly over, as the ECB now holds its key deposit rate at 2%. When your borrowing costs exceed the rates you're paying on existing debt, basic math tells you that's unsustainable. In the UK, for instance, gilt yields are now at 4.7% higher than during the 2022 crisis that brought down a government. Second, the sovereign bank nexus has created a deadly embrace. Research shows that in developed economies, banks hold government bonds worth trillions of dollars. When sovereign debt becomes distressed, it doesn't just hurt governments, it devastates the entire banking system that holds these bonds. This amplifies the crisis exponentially. Third, we're seeing warning signs everywhere. Deutsche Bank analysts rank France as the most likely G7 country to experience a government bond crisis, followed by the UK and US. French yields are trading at Italian levels despite France not running a surplus since 1974. The IMF's own data confirms our worst fears. Global debt has hit a record $338 trillion, with advanced economies averaging 110% debt to GDP versus just 74% for emerging markets. Think about that. The supposed safe haven developed countries are now more leveraged than emerging markets traditionally considered risky. Finally, fiscal space has evaporated. With aging populations, climate costs, and geopolitical tensions requiring massive defense spending, these countries face structural deficits with no room to maneuver. The Congressional Budget Office projects U.S. debt will continue rising indefinitely, driven by debt servicing costs alone. We're not heading toward a crisis. We're already in one. The only question is which domino falls first.
Thanks for laying out that catastrophic vision, but I think we need a serious reality check. My opponent wants you to believe the sky is falling, but the data tells a very different, much calmer story. First, let's tackle these big, scary numbers. My opponent throws around figures like Japan's 235% debt to GDP ratio as proof of a coming collapse. But here's the context they left out. Japan has had debt levels over 2% for more than 15 years, and there has been no crisis. Why? Because their own citizens and institutions hold near 90% of that debt. It's a closed loop, a stable system, not a ticking time bomb. Next, my opponent points to a record global debt of $338 trillion. It sounds terrifying, but a huge chunk of that increase comes from a weaker US dollar, which simply makes debt in other currencies look bigger when converted back to dollars. The more important number, the global debt to GDP ratio, has actually been falling from its pandemic-era peak. The debt burden isn't getting heavier, it's getting more manageable. My opponent raises the sovereign bank nexus, and they're right that this creates real risks. Banks do hold large amounts of government bonds, and this can create feedback loops during stress. But here's what's different now. Regulators are watching this closely and have tools to intervene. We have regular stress tests, capital buffers specifically designed for this risk, and central banks that can provide liquidity backstops. The risk exists, but it's being actively monitored and managed, not left to chance like in previous crises. And what about France, which my opponent claims is on the brink? Yes, there's political noise, and analysts love to make predictions. But the facts show that demand for French government bonds has remained strong, even with rising yields. Investors see an opportunity, not a five-alarm fire. A ratings agency downgrade is a risk, not a guaranteed crisis. Finally, the argument about the U.S. running out of fiscal space. Projections of rising debt from the CBO are a call for responsible policy, not a forecast of imminent doom. The U.S. has a unique, powerful advantage that my opponent ignores. It borrows in the world's reserve currency. This gives it a level of financial flexibility that no other country has. So, when you look at the complete picture, the narrative of an imminent crisis falls apart. We have stronger central banks, more resilient financial regulations, and deep, stable markets in advanced economies. The challenges are real, but the system is far more robust than my opponent gives it credit for. A crisis isn't just around the corner.
My opponent paints a rosy picture, but the numbers tell a very different and much more alarming story. Let's get clear on the facts. First, let's talk about the interest rate trap. In the United States, the cost to service the national debt will hit nearly $1 trillion in 2025 alone. To put that in perspective, that is more than the entire national defense budget. This isn't a sustainable path. It's a fiscal death spiral where a country has to borrow more money just to pay the interest on its old debt. Second, look at the European powder keg. My opponent suggests Europe is stable. Yet in September 2025, for the first time in history, financial markets decided that lending money to France is just as risky as lending to Italy. Around the same time, Fitch downgraded France's credit rating to its lowest level ever, citing political gridlock and rising debt. These are not minor market jitters. These are seismic cracks appearing in the foundation of the Eurozone. Third, let's dismantle the Japanese illusion. We are told Japan is safe because it owes the debt to itself. This is a dangerous misunderstanding. When the Bank of Japan is eventually forced to raise interest rates significantly, it will trigger devastating losses for the very same domestic banks and pension funds that own all the government bonds. This creates a doom loop that can destabilize their entire financial system from within. It's a house of cards, and the wind is picking up. Finally, don't just take my word for it, listen to the regulators. The European Central Bank's own Financial Stability Review from May 2025 explicitly warned that rising debt and higher interest costs pose a direct challenge to the sustainability of government finances. They see the crisis coming too. These are not abstract risks for the distant future. These are concrete numbers, official downgrades, and direct warnings from central banks happening right now. The debt crisis isn't just brewing. The pot is already boiling over.
My opponent paints a scary picture, but it's a picture that selectively ignores the other half of the story. Let's look at the facts. First, the interest rate trap in the U.S. My opponent says $1 trillion in interest costs is a fiscal death spiral. But let's put that number in perspective. $1 trillion is about 3.2% of the entire U.S. economy. For comparison, back in the early 90s, the U.S. spent over 3% of its GDP on interest payments and no crisis occurred. What's more important is that the U.S. has the unique advantage of borrowing in the world's reserve currency. This creates consistent global demand for its debt, keeping borrowing costs manageable. Second, the European powder keg. My opponent points to the Fitch downgrade of France as a sign of imminent collapse. Let's look at what Fitch actually said. They cited both political gridlock and rising debt. But this isn't news. Markets have been pricing in these risks for months. The key point is that even with this downgrade, there is no crisis. Why? Because the Eurozone now has powerful backstops. The European Central Bank's Transmission Protection Instrument, TPI, was created for exactly this scenario, to counter disorderly market dynamics and prevent a crisis from spreading. This isn't 2012. Europe has built the firewalls. Third, let's dismantle this Japanese illusion argument once and for all. My opponent claims rising rates will create a doom loop, but this ignores two critical facts. 1. The Bank of Japan is not on some reckless path to high interest rates. Their own meeting summaries from last month show they're being extremely cautious and gradual. 2. The bondholders themselves, like the giant GPIF pension fund, have a legal duty to ensure long-term stability, not to panic and sell. Their entire strategy is built around resilience. A doom loop requires panic, and these key players are structured to prevent it. Finally, my opponent says to listen to the regulators. I agree. And what do? They issue warnings, conduct stress tests, and increase capital requirements. That's their job. The ECB warning is a sign that the system of monitoring and prevention is working, not a sign that it's failing. It's like a smoke alarm going off. It's there to prevent a fire, not to signal that the house is already burning down. The risks are real, but the system is far more resilient than my opponent acknowledges. We have the tools, the historical precedent, and the institutional frameworks to manage these challenges without a full-blown global crisis.
My opponent has spent this debate telling you not to worry, that the system is under control, that regulators have built firewalls, and that this time is different. But let's look at the simple, hard facts they want you to ignore. They say $1 trillion in interest payments for the U.S. is manageable. I ask you, when servicing your debt costs more than your national defense budget, is that management, or is it a nation trapped in a fiscal death spiral? They tell you Europe has firewalls. Yet we just saw France, a core economy, get a historic credit downgrade while its borrowing costs spiked to match Italy's. Those aren't firewalls holding strong. Those are cracks appearing in the dam. And they praise regulatory warnings as a sign the system is working. But a smoke alarm is a warning of fire. You don't celebrate the alarm while ignoring the fact that the house is burning down. The fire is the mountain of debt. The smoke is the trillion-dollar interest bill. Ladies and gentlemen, the fundamental math is undeniable. Record debt, rising interest rates, and slowing growth have created a perfect storm. This is no longer a theoretical risk. It's a mathematical certainty unfolding before our eyes. The crisis isn't coming, it's already here.
My opponent wants you to focus on one side of the ledger, the debt, but that's only half the story. Throughout this debate, we've heard about scary numbers and death spirals, but we've shown that context matters. They point to a $1 trillion interest bill in the U.S., but we've shown that relative to the size of the economy, it's manageable and has been managed before. They point to a credit downgrade in France, but we've shown that Europe now has powerful new tools like the TPI, a firewall built specifically to prevent the kind of crisis they describe. And they tell you to fear the regulators' warnings, but we've shown that these warnings are a sign the system is working. A smoke alarm's job is to alert you to smoke so you can act. It's not proof the house is already lost to a fire. Ladies and gentlemen, the core of my argument is simple. Risk is not the same as crisis. The world is full of risks, but we have built a far more resilient financial system to manage them. We have stronger banks, more powerful central banks, and better coordination than ever before. Don't let the fear of big numbers cloud the facts. The evidence shows a system that is managing challenges, not one that is collapsing. Thank you.
All right, over to you, the judges. What do you all think? I'm looking forward to seeing your votes and thoughts in the comments section. We love hearing what you have to say, and I believe every perspective brings something valuable to the table. Also, I've done my best to fact-check the information you've just heard, and you can find the relevant links in the description box below. Before you go, don't forget to hit that like button and subscribe. Your support means the world to us. We'll see you next time. Bye-bye.